EBIT margins of 16.5, aspiration to get there by quarter 4 FY27.
We are expected to see marginal uptick in the profit growth, barring IndusInd Bank and Bandhan Bank.
This is the third largest component, which is Reliance, is holding well in the green ahead of numbers.
Consultation paper will be out very, very soon on this to allow them to net in some respects.
We are looking at beyond content for growth, and that is what has really helped us this quarter.
The Nifty is well below the 25,800 mark, which we conquered today, back again.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and with me is Prashant as well as Mangalam. For the markets, we're trading in the green, but we're a distance away from the highs that we saw earlier today. The Nifty has come off. We're up only around 40 points. In the first half of trade, it appeared we were gunning away towards that 25,900 odd mark, but we have given it up from the top. Tech is the index that's been strong all through the trading session. Infosys, 29% of the Nifty IT index is on account of Infosys. If Infosys does well, then that's doing bulk of the heavy lifting, still holding with gains of close to around 5%. But it's a very big earnings day for the next couple of days. So you have Infosys that's reacting today, and there'll be pre-positioning on Reliance Industries, HDFC Bank, ICICI Bank, and throw in there Tech Mahindra as well as Wipro. So action-packed earnings day. Hey, gentlemen, what's up?
Hi. Mangalam, hi, Nigel, hi. And, not being able to hold on to pop, right? I mean, at one point, almost 200-point gain and just 20 points to show for it as we wind down and wrap up the week. Kind of in line, I mean, it's disappointing on the day, but I think it's in line also with what we've seen for the rest of the day, rest of the week, I mean, with a holiday thrown in between. Just not being able to hold on to higher levels and getting sold into once again. So 25,690, lots to talk about here over the next 60 minutes. Mangalam, hi.
Take that point. Today we had all the reason for the market to actually break out, try and attempt a breakout at least, because the Nifty Bank was doing well, the Nifty IT index was doing well ahead of numbers, Reliance was holding on as well. But turns out that we are, in this broader range of 25,550 to closer to 26,000 as we move towards that 25,900 mark. Today's high also just about 25 points away from there. What's interesting is that, we are seeing some decline in the pharmaceutical names, yes, but that doesn't account for a big weight on the index. But the FMCG names, they're coming in for some selling as well. So pull up something like an ITC, that's lower. The pharmaceutical index is at the low point of trade right now. And even the auto names, something like a Maruti or an Eicher Motors, etc., they have been fairly well sold. ITC has been, lower through the course of day, and right now currently at the low point, as is the auto index. So good time to tell you what's lined up on the show right now. The market trims gains. The Nifty slumps below that 25,700 mark. The Pharma pack feeling the heat. Cipla among the top drags on the Nifty. On the flip side, it's an earnings-led fillip for a lot of the banks today. The likes of Federal Bank extends gains following that strong earnings report, nearly 8.5% on that stock. And coming up in just a bit, we'll talk about the other high-flying packs of IT, Infosys, L&T Tech Services, both of them robust set of numbers, a detailed fine print of those numbers as well coming on Closing Bell. It's going to be an earnings-heavy weekend. The likes of Reliance, ICICI Bank, HDFC Bank, Tech Mahindra, Wipro, all of them set to report their results today, tomorrow, over the next couple of days. What should the expectations from these performances be? All of that coming to you on Closing Bell over the next 1 hour or so. But the big question, how should you position yourself in the last hour of trade? Mitesh Thakkar, as always, joins in. Mitesh, good afternoon. We've not been able to build on to the gains or the good, start that we had. We've sold off from there.
Well, that's right. I think very clearly, as I said in the morning as well, this is a market which is not showing signs of any kind of directional bias. So it's just chopping around. One day it's down, one day it's up. But on the upside, till we get past levels of 25,950 broadly, I think give it take a few points. I think till then, I think the structure will not turn positive, and therefore you will remain in a choppy kind of an environment with chance of and a strong possibility and a chance of testing 25,400. So that's the kind of view on the index. Therefore, not much happening on the index for the timing for me on the charts. Yeah.
Okay. All right. Mitesh, I wanted to particularly ask you about the tech index, the biggest underperformer of 2025. Any kind of good news is being well received. And that's why even in today's wibbly-wobbly trading session, you have Infosys that's doing bulk of the heavy lifting. 29% of the Nifty Tech Index is on account of Infosys itself. and that's holding its own. How are the charts looking both for Infosys and the tech index, if you have a view?
So I think, Nigel, very clearly, the tech index, is showing some signs of revival. And my sense is that if you look at the recent historical charts, we've seen the tech index, the Nifty IT index, that is, peak out around this 39, 300, 500 zones. First, it happened in the June of 25. Then again, I think, in December 25. I think once we get past these levels, and there are certainly chances of that, I think the tech index could head towards 40,300. And in a good case, 42,000 as well. So the structure is positive. I would still believe that slowly the tech stocks will kind of reverse their underperformance, come into the long side.
All right, we'll come to you on shortly for the picks, etc. But in the meanwhile, just address Federal Bank. Big move is what we saw post the company reported its numbers, and now we're getting some commentary from the press release and the management commentary as well. Gaurav joins in with more on that one. Gaurav, Federal Bank, the street really like these numbers.
Well, as it seems that street actually appreciates any positive surprise that we saw in the stock price, and that is what happened in Federal Bank today. Because if you look at the numbers, street is expecting a stable quarter, but bank reported very strong quarter this time. And the reason being that if you look at net interest income, that increased almost by 9%, PPOP increased almost by 10%, and this was supported by the other income, and within other income as well. If you look at the fee income element, that increased almost by 18% on a year-on-year basis. It was above the street's expectation. As a result, coming to profit, that also increased almost by 9%, and that number may look in a single digit, but it was 4% ahead of what the street is expecting. Apart from that, net interest margin, that was a big surprise. We saw 12 basis point of increase in net interest margins. Now it stands at 3.18%. And even in terms of asset quality, the bank did not disappoint at all. In fact, gross NPAs declined almost by 11 basis point. Same was seen in slippages as well. Slippages came down to 0.7% versus what it was at 0.9% level. When it comes to advances, we saw 4.5% increase on a sequential basis. It was more or less in line with the street's expectation, and same happened in deposits as well. 12% growth on a year-on-year basis, in line with the street's expectation. But given that there was surprise in net interest margins and asset quality, street has taken it in a very positive way. Apart from that, let's also not forget about the ROAs. Now they have increased to 1.15%, and remember, by FY28, management was expecting ROAs to reach 1.4%. So it seems that they're actually heading towards that 1.4% mark, and it can happen anytime soon. Lastly, let's also not forget about the medium yielding segments. Management was very clear that medium yielding segment should contribute higher, and that is what we saw in this quarter as well, which was the medium yielding segment, which was 43% of the overall loan book. Now it stands more than 44%. So that is also something that they are improving. So all in all, very good set of number. They are also delivering what they had mentioned earlier, and as a result, that is something that we saw in a stock price as well today.
All right, Gaurav, thanks a lot for that. Let's go back to Mitesh. I think his picks are left. Mitesh, your picks for this hour, and also a call on Federal Bank.
No, Federal Bank I'll avoid because we have some positions, so I'll avoid commenting on that. But on the stock side, HCL Tech is a buy with a stop at 1677.75 for targets of 1730, 35. And Asian Paints, it's a structure which has slightly grown negative in the last few days. So I'm just waiting for a breakdown. The trigger will be if the stock starts trading below 2740, or about 14, 15 points away from there. So if it breaks 2740, go short with a stop at 2770 for targets of 2680.
All right, take that point. Just as we speak, though, the tech pack continues to do well. Tech Mahindra up around 5.5% right now, up at the high point of trade. AU Small Finance Bank as well, doing fairly well, up around 5% for that counter too. But speaking about banks, let's hear out the word coming in from the management of the PSU lender, Union Bank, on what they expect with respect to the net interest margins going forward. Listen in.
So we said we want to defend it, and yes, aspiration is to improve further. Actually, we worked upon the efficiency ratios in this entire quarter. These measures on the asset and liability side, we could maintain it. So now I feel that still next 2 quarters, we certainly possibility is there for further, but then we would like to defend at this level because we do have opportunity, of some re-rating of the deposits and maybe some shedding of some few more bulk deposit at higher rate.
Okay, all right. Well, let's go across to Gurmeet Chadha, managing partner and CIO at Complete Circle, who joins us on the show. Hi, Gurmeet. Good afternoon. Good to see a couple of earnings surprises at least. Federal Bank did well. Union Bank actually did bounce up and trade a couple of trading sessions ago. What's your preference from the pack?
So, Nigel, we discussed Federal since Mr. Manian took over. So there was a leadership change, and I think what they are also doing is delivering on what the roadmap was. So pretty strong set of numbers. I think the NIMs expanded, asset quality was better. As a result, everything grew. So if you see the core POP, CASA improved, and everything got reflected. And I think with the cost of funds further likely to come down, I think there is some more room for interest rates to fall. I think the bank has really re-rated from about 1.1 book value when he was sub 200, and now trying to catch up with some other private banking players. So I think very steady set of numbers. Also, the environment has been very supportive with a lot of FDI coming in, whether it's been Federal, RBL, some of the leading NBFCs. So we remain overweight financials. I also think some of the large private banks are due. We have almost 25% of Nifty earnings between today and tomorrow with Reliance, HDFC, ICICI. I think that could decide the next charter for financials, but we're pretty overweight. And I think even the capital market plays, I think if NSE, NOC comes in time, I think there'll be some bit of a boost there as well.
I take that point, Gurmeet. Also, the greetings for Lodi to you and your family, as well as all your colleagues. Just wanted to understand if you have a fresh view on IT after the Infosys numbers, because extremely underowned. A lot of people are worried about how things will pan out for them, but things are good at a price, right?
Yeah, absolutely. I think the numbers were better than what I think it's completely underowned. There's not much expectation with IT, and I think HCL initially and then Infi surprise. So what happens is when you are underowned or let's say net short at a technical level, even a small positive surprise can be a boost, which is what happened with Infi. And in fact, I found HCL numbers better. And I think there's one area which probably will need more analysis is their software business. It contributes 11% to the revenue, but almost 22% to EBITDA. And that's how the overall blended margin goes up, and that business looks very good. So it's much more diversified than just clubbing the entire large cap IT with US exposure. I also think the earnings of Coforge, especially what they have done with a very ambitious acquisition, Persistent, and some of the better mid cap names would be essential. But any positive surprise in earnings can lead to a bit of a tactical bounce. So some part of the portfolio can be on contra and under-owned plays like materials, chemicals, bit of IT, where you have valuation comfort and good earning visibility.
Absolutely. And I think we'll see, you mentioned a bunch of acquisitions. I think we'll see more this year because, TCS, by the way, made a very large acquisition. It's a $700 million acquisition late December. There's, Coforge, as you said, and maybe a lot more coming. Basically, trying to bridge the gap with, AI-led firms. And but of course, I mean, none of them come cheap. The TCS one, a very large one. They paid some 5 times sales. With Coforge, for example, some question marks at the margin as well. But I think more and more firms, I guess, on the M&A path, as they realize that they need some of these technologies, if not in-house, buy them to fill these, so-called white spaces in that sense. Let's stay with IT, right? And I guess let's round up numbers from Infosys and L&T Technologies. Rima is here with just a quick fine print view. Rima, over to you.
So it's a tale of two cities when you look at Infosys and LTTS. Infosys has delivered a good Q3 ahead of estimates. FY26 guidance has been raised to 3.5%. And plus, the management sounds upbeat about the financial services vertical. Brokerages have raised estimates, their growth forecasts. CLSA is saying that next year the company will grow at 6.3% versus their earlier projection of 6%. Jefferies has raised EPS estimates, and Jefferies says that the EPS growth for the company is likely to be 7.5%. Analysts we spoke to also pointed out that on top of this EPS growth, it may be 7.5%, but there is a dividend yield that IT companies provide of 3-4%. So if you add the two, then there is a possibility of a 10-12% kind of return, pretty steady, especially when you put it in context of the valuations, which are not prohibitive. The stock trades at 21.5, 22 times forward multiple, and the stock has underperformed in the last 1 year, down close to about 10-12%. LTTS, on the other hand, is getting impacted because of a very conscious decision taken by the management to recalibrate its entire business. So they said that they assessed the full portfolio. They met with the strategic advisor Advisory Group, all their clients at MIT Labs, and they took stock and they found that certain parts of their portfolio are getting commoditized. They are low margin business, and therefore the company said that we took a conscious call to exit those low margin businesses, deprioritize certain geographies in the technology vertical in Europe and in India, and pivot towards higher margin. So that's getting reflected in the numbers. Revenues declined 2.8% in Q3. The full year guidance was also brought down to mid-single digits, but margin performance will be stronger. So the company's margins expanded in Q3, and they're talking about an aspiration of 16.5% margins by Q4 FY27.
Rima, thank you very much for that. That's IT for you. By the way, another name which is selling off sharply is Hitachi. Hitachi is the number 2 volume-led loser on the NSE. It's down another 4.33%. The high last month, the high in December was 23,000. Stocks at about 16,000 now. Any thoughts on this space, Gurmeet?
One thing, Prashant, not really specific to Hitachi, but in general on capital goods and EPC plays, is that I think there is a sense that the budget would be more with the fiscal constraint, more on the consumption side, and more on ease and operational easing and reforms, and bit of a tweaking in customs and maybe STT or LTCG at some point of time. And there could be a slight moderation in the overall capex spend. And obviously it's a function of what numbers and all we do. So you got to wait and watch. So you could see a bit of a pivot towards more consumer names and more material names, and maybe within EPC or infra, maybe some of the power transmission name, because that's where the big bottleneck is. And in terms of transmission, I think the private transmission capex is hardly 8-9%. The government would like to boost that. That's a big bottleneck. So that you have to be a little watchful of. So there could be a small bit of a softening or rotation leading up to budget, maybe from capital goods and more EPC plays towards some of the consumer and other names.
You mentioned STT and LTCG, etc., with a wry smile. Gurmeet, any serious expectations, or no?
No, I think I think somewhere this kind of supply pressure is very difficult to absorb, Prashant. So just see the kind of redemptions we have had, and I think some point of time we may consider either on STT in terms of reducing the cost of transaction, or maybe having a slightly different view to long-term patient capital. So a lot of the endowment funds or pension funds globally are not taxed the way we have started doing after 2018 when we increased LTCG. So I'm not speculating. I'm saying something could be relooked at. And also, I think if you see there's a just flash on reaching out to some of the FPIs in terms of netting of cash transactions was to be done. So I think a little bit needs to be done to attract patient capital. We are a growth-hungry nation, and I think if something goes there, it can quickly reverse the sentiment.
Something that's growing right now, it's a lot of these value retail players. Look at bazaar-style retail. It's up 19% with decent volumes as well. Remember, the company reports its numbers sometime next week, 20th, if I'm not mistaken. And at the same time, they're also looking at fundraise. The volumes today are what? 40 times average of what we've seen on the stock usually. So about 1.5 crore shares traded on bazaar-style retail already. Gurmeet, V-Mart, V2, bazaar style, or you would look at something like Trent or D-Mart, the good old D-Mart?
So, we are a little more towards the new age consumption names. I think any dips we've added Returnal. We are looking at some of the more premium consumption plays. I think even the consumer durables space has seen sharp correction. Let's say, for example, LG, after a stellar listing, has been very soft. And I think last quarter should be better. And the business is less cyclical compared to the Voltas or the Blue Stars of the world, because they have a portfolio across OLEDs and refrigerators and washing machine, and the premium portfolio does well. So we are more inclined towards that than pure retail names. Trend, obviously, I think is a bit of a de-rating going on with now growth being more at 15-18%, so still expensive. So we are more positioned there, and anything to do with more premium consumption and new age is something we are more positioned in.
LG that we're talking about here?
Yes, LG Electronics we've added in the recent correction we've added. I think that's a more structural play on consumption picking up, GST benefit paying out.
Right.
And as I said, their premium portfolio is inching up. Their market share, whether it is OLEDs or the double door refrigerator or high-end products, is almost 40-50% in most spaces.
And when you say new age, you mean any of these current listings? The likes of Meesho, there's Lenskart, there's so many.
Yeah, so we have Eternal in the portfolio. We have a bit of Paytm there. We added Grow around 140 odd levels. We are looking at Meesho at probably slightly more better price point if we get lucky.
All right, take that point. Always a pleasure speaking with you, Gurmeet. Thank you so much. Have a good weekend. We'll speak to you post all the big earnings, 25% of the earnings that you're talking about on the Nifty. Take a short break, come back. On the other side, the Alpha Manager of the Day, Vaibhav Sanghvi of Ask Hedge Solutions joins in.
$20 points higher. I mean, I should say only 20 points higher because it was 200 earlier. 25,690 is where we are at. We are, of course, getting into the last 40 minutes of trade. Vaibhav Sanghvi is CEO, Ask Hedge Solutions. Vaibhav, good to have you with us here. Thanks for joining in. I was asking about these power equipment companies. Actually, Hitachi is down sharply, but look at GE Vernova, another 6% lower. CG is lost, I think, from 800, 900 levels, stocks down to 550. Very sharp falls across the board. Gurmeet was with us and he was saying that maybe one reason is the budget's expected to focus more on boosting consumption away from capital goods, etc. But I think there is this Chinese equipment players being allowed for government tenders, etc., which is also a factor. Any thoughts on at what price do some of these become a little more attractive? CG especially, right? I mean, CG is building out other businesses. I mean, this is just one business, the transformer business. They got a railway business. They're, of course, doing the OSAT business, which is a new one, but one of the few companies which has got central government subsidy. What's your sense, Vaibhav?
I think, first of all, thank you for having me. But, from a sectoral standpoint, which you rightly pointed out, I think, from our perspective, the trigger point has been, from the market buzz about the Chinese equipment makers being allowed to kind of participate here. Are not good, or probably the profitability matrix is not good. I think everything of that is in pretty much good order. In our view, which is slightly different from the street of what it is kind of showing, our view is basically data center is going to be an extremely big opportunity, and anything to do with the data center, including the equipment or probably power companies and the grid to kind of supply that. I think it's going to have incremental kind of capex coming about. So it's not only about the government putting in that money, but all the private companies who are going to spend a lot in this whole segment as well. So we do like this space. Unfortunately, in the last fortnight, I think it's kind of got marred by the whole buzz about these Chinese equipments. But that buzz has to be clearly seen with the context that there were supply shortage of certain equipments, from an overall grid perspective, and that is what that is what catered from Chinese side as well.
Right, Vaibhav, at the start of this year, we spoke to a bunch of market makers, intellectuals, and all those who manage a lot of money. We asked them for their Nifty expectation in terms of returns for 2026. A large part of them said between 10 to 20%. You are in the camp that you believe that the market over the next 3 years can actually give you more than 50%. What drives this optimism, and what sectors would drive this growth?
See, I think the way to look at it is basically that from an overall perspective, last 1.5 to 2 years, we have compressed in terms of the P. Second, from an FPI ownership in India, we are almost a 15-year low. Thirdly, it is also largely driven by the overall AI shift towards China, Korea, and Taiwan. Our view is basically that in the last 1.5 hours, where we've seen the earnings pretty subdued, in fact, earnings downgrades kind of happening. I think that kind of stabilizes, and we look up from here onwards in terms of the earnings. Lastly, the GDP growth, which again we'd seen some very dull period in the last year. I think it's been on the recovery trend at least for the last 2 to 3 quarters. To be very honest, the earnings kind of lag the GDP growth, and I would continue to wish for more nominal growth coming into the play. But as things stand, our view is that we are at a cheaper valuation, the earnings growth stabilizing. For the next 2 years, we are looking at about 14 to 15% earnings growth. So in all likelihood, I think we should be following the earnings growth trajectory, which is nothing new, but just the historical perspective where markets continue to follow the earnings growth. And in our view, it is more of an earnings growth story with slight amount of PE re-rating, which makes me optimistic for the next 3 years.
Vaibhav, forget about the upside. What about the downside from here? In the last few days, this call of, barking up the wrong tree, we're getting too optimistic. FI holding last year, 14-year low. This year, it's a 15-year low. That's the kind of selling that we have seen. Earnings growth pick up, yes, that is the hope. Nominal GDP, yes, hopefully it goes to double digits. All that is known. But that call for maybe seeing a swifter correction, the broader market staying in pain, and maybe headline index corrects as well. What are the odds? Sometimes when these voices get a little louder, it's not such a bad thing. And from there, sometimes the market does reverse. So if you put out downside on the index itself, what do you think? How low can we go from here?
See, I think, Nigel, to look in, from your perspective, I think you're right in terms of saying that the FPI has been the pain point, from an Indian market standpoint. And it's not only about last 6 months or probably since the Trump kind of announced the tariffs. It is actually, if you look at it, it is happening right from 2022 onwards, wherein the Fed has started to increase the rates. Now, looking at a broader perspective, when the rates should have come or had come down, the logical conclusion would have been that emerging markets should have witnessed some inflow, which we didn't see. And the point is basically because of that AI trade, we've seen that shift of flow probably from India or not allocating towards India and going to China, Taiwan, and Korea. And that also got coupled with your earnings dullness, growth dullness, and which is why, or cumulatively, we didn't see any action from the APIs. Having said that, whether this can continue for a few more months, of course it can continue. We do not know the timing of it. But all in all, we can see that the variables surrounding it are actually getting in place one by one till the time that somebody would not be able to ignore a good growth story. So my guess is, and that's why we say 3 years and not probably 3 to 6 months.
So you think that we're closer to the end of the painful period? Would that be fair?
Yeah, provided if the earnings kind of not start deteriorating, honestly, because if earnings start deteriorating, then markets will follow that.
Hopefully, we get those mid-teens growth, at least that 12 to around 15%. Then the markets at least will be at least steady, if not move up. You were talking about value a couple of times during this conversation. 2026. What is that one sector that you're very, very bullish on? You mentioned data centers as well. You want to drill it down a little bit. That one theme that will actually play out.
So, Nigel, again, I think not only one theme, but few themes. One, of course, data centers and anything relating to data centers. Maybe it's cooling equipment, or maybe it is power and utilities. I think that's a segment to watch out for. In addition to that, I think banks on an overall basis, after mediocre growth in terms of the earnings, pressure in net interest margins, I think things are stabilizing with credit growth looking up as well. So, of course, that will also get influenced by the amount of FPI flow which comes into it. But that is something which, from a fundamental perspective, we are liking it. In addition to that, CDMO players are the guys we still are kind of very keen on. So overall, apart from the consumption, which we have been seeing for some time, these are the sectors looking good for 2026.
Is there anything that you don't like? Something that you believe has maybe either run its course or perhaps has no future triggers in terms of the growth expectations?
See, if I see from a sectoral perspective, pharma is coming under a slight amount of pain, and purely because of the generic players who has a sizable exposure to a drug which is Revlimid. So my sense is basically, I think you will see pressure on those numbers continuing through this year. Pharma has been a good sector, in the last 2 to 3 years. I think this is a time to get pulled off. In addition to that, I still don't understand the overall, rally from a base metal perspective in a light that, the global growth is not very encouraging. Now, we'll see where it kind of ends, but when it ends, I think that can be a little ugly as well. So not preempting it, we'll wait for those kind of corrections to take place to see what we can take in terms of a view which is constructive on the negative side.
Look at the currency go, 90.84, and it is under pressure. And how?
That's what
once again, so it's just going one way, right? I mean, actually, if you keep if you put this chart and put the Nifty chart, it'll be exactly the opposite. I mean, this kept going higher, the dollar rupee across, and the Nifty, of course, sinking on the other side. So that is that. We'll maybe try and get a voice in from the Forex side in a little bit from now. Thank you very much for joining us, Vaibhav. Appreciate your time here. There you go. I think that's pretty much, it does the job, right? I mean, tells you what has happened today. Let's talk about what the F&O positioning is changing and how is it looking now. At an extreme, especially FI shorts, etc. Nigel, take it away.
Well, that's right. The FI shorts are extreme levels, but the PCR has got some distance to go because in the last 10 days or so, we saw it going down to around 0.62, and from there we saw a bounce. Last time I checked, it was at around 0.76, so it has some room to go on the downside, though the call writing is getting rather aggressive. And that's clearly evident in today's trading session because, as you all mentioned, yes, the Nifty is up. But take a look at the 25,800 call. You've got the direction right, but the premium, in fact, is down by close to around 6% or thereabouts, telling you writers are at play out here. While the 25,900 call as well, there's a bit of mixed activity out there as well. So though you're getting the direction right, you're not making any money if you're buying those calls. So the writers, well, they are at play out here. The level that you're looking at, recent low, ballpark around 25,450. That's the level you don't want to break on the downside, because otherwise you're calling for the 200 DMA, which is closer to around the 25,000 odd mark. On the upside, 26,000 mark. That's going to be a very, very firm resistance. 20 DMA, 50 DMA out there. Options data as well suggesting that, out there at the bears, they'll come in to fight and protect that 26,000 odd mark. Individual stocks are in focus. Yes Bank. That stock is coming for a bit of a short covering bounce today. So the banking index itself is doing well. And some of these smaller banks, whether you look at Yes Bank, whether you look at PNB Bank, both of them are seeing a bit of a short covering bounce in trade today. And from the broader markets, the metal index actually has come in for some selling, but it appears more it's unwinding of long positions. Case in point being Nalco. That's seeing some unwinding of positions. The stock is down 2%. You have open interest as well down. In terms of stocks that are seeing buying, Federal Bank stands out. Fresh buying being seen on that particular counter. So the day has been, a bit of a sluggish one. Though the Nifty is up close to around 40, 50 points, you are seeing the call writers are at play, telling you that belief is still not there that we can go ahead and conquer the resistance levels. So the 500-point range is maintained despite the Nifty Bank firing away all cylinders. Back to you.
Take that point, Nigel. Thanks a lot for that. Sometime during midday when the Nifty was closer to that 25,870 mark, the put-call ratio had moved to almost 1.2, and from there, so retreated back against to 0.76 right now. And as Prashant pointed out, the rupee at the day's low along with the market. We'll take a short break, come back on the other side. We'll tell you what the dealing rooms are saying in our special Day Street Chatter segment. Also, get you the tomorrow trades.
Welcome back. You're tuned into Closing Bell. The rupee at the low point of the day and the Nifty as well has come off the highs. Gives you a sense in terms of sentiment right now. Good time though to find out what's going on in D Street Chatter. Nimesh joins in to tell us. Nimesh, what's the buzz in the dealing rooms? The bulls must be getting frustrated. Yeah? Even on a day like this when you thought you were going to be flying away, come off the top and plenty of pain in the broader markets.
Well, absolutely. Nigel, so market off day is high, but there is still a lot of momentum. So IT has done well today. Bank continues to outperform. So IT index is up 3% thanks to the Infosys numbers, and that's actually led to a bit of a short covering bounce in the other IT names as well. And on top of it, we have Wipro and Tech Mahindra numbers. So again, that's something to track. I guess earnings is a big thing to watch out for. We are seeing a big reactions to at least decent sort of earnings. So Federal Bank is a classic example today, up 9-10%. On Wednesday, we saw a big reaction to Union Bank after the numbers. So clearly, because all the prices have corrected so much, a bit of good news, and the market is rewarding as well. So that's something to track going forward. I guess for Monday, the Nifty will be in focus largely because of the big earnings from the large caps. So Reliance, ICICI Bank and HDFC Bank all gets reported over the weekend. So if all the three support the bulls, you might see a big rally on Monday. So that's something to watch out for. Technically, 850 is a level to watch in the upside. That's been acting as a big resistance as well. So need to see on Monday if that gets taken out. Then you might see a further short covering rally. But I guess while a bit of profit booking in broader markets, I guess a bit of a Friday factor as well. But there is clearly momentum in banks as well as in technology names today.
All right, Nimesh, technology names is where some buying is. Apart from that, any individual stocks which could be in focus?
Well, so the first stock on my list is AB Capital. That's been buzzing off late. In fact, if you look at the recent shareholding pattern, some of the domestic mutual funds have added as well in the last couple of quarters into AB Capital. And now there is a very strong buzz that post earnings, you might see a corporate development as well, a potential fundraising in one of the subsidiary business. That's the buzz as well as far as AB Capital is concerned. That's the first name. Pine Labs is the other stock in focus. Off late, we've seen a bit of momentum back. I understand some large HNS have bought as well. The volumes also picked up, and again, there is some sort of sense that maybe momentum is back in Pine Labs. So that's buzzing off late. The third name is Federal Bank. We spoke about the earnings, and it's been a big quarter in terms of very strong earnings. But apart from that, I understand leading family office has been accumulating Federal Bank off late. So there is delivery happening in that particular stock in the last many weeks. And the last name is Sun Pharma. Again, within the pharma name, this has been under pressure of late. I highlighted a few days back as well. There is a very strong indication that maybe the company is going for a very large acquisition overseas. And that's the reason why the street is a bit nervous in Sun Pharma of late.
Okay, a bunch of these large acquisitions in the pharma space, right? I mean, at least that's what I think we've been indicating towards. Sun perhaps a bit under pressure. Thank you very much, Nimesh, for that. Well, I just get you the trades as we go into Saturday and Sunday. Mitesh is here. Mitesh, what's the recommendation?
I think Infosys has spent the entire day with strength, and now near the day's high. I think VTST with a stop at 1677 can be taken with a target of around 1710 on the upside. And Kotak Bank is slightly closing with weakness, so we'll take STBT here with a stop at about 421.5 for targets of 412.
Okay. All right. So those are some specific short-term sort of trades. Now, we are, of course, awaiting numbers from Reliance and the banks, etc. But there is the other big result, which is also trickling in, which is the BMC closely watched Mumbai municipal poll results. Sante has got the latest with all the leads, trends, etc., which have come in. Sante, what does it look like?
So now it's clear that BJP and Eknath Shinde's Shiv Sena have emerged victorious in these BMC elections and will be able to appoint their mayor to Asia's richest civic body. BJP has clearly stolen the show here. BJP has not only cut Thackeray brothers to size, but they have also outperformed their own ally Eknath Shinde's Shiv Sena. Now talking about these elections, BMC elections were held after 9 years and after a delay of 4 years. In 2017 also, BJP performed very well. In 2017, when the last BMC elections were held, at that time, Shiv Sena, the undivided one, Shiv Sena won 84 seats and BJP won 82 seats. An impressive number for BJP given the dominance the Thackeray family and the undivided Shiv Sena had over BMC at that time. But now things have clearly changed, and based on the numbers so far, BJP and Shiv Sena, especially BJP, have emerged victorious and will be able to appoint the mayor to BMC.
All right, so the leads are now clear. It is BJP and Eknath Shinde-led Shiv Sena which would be appointing the mayor of the Mumbai Municipal Corporation. Let's go across to Sudeep Bandyopadhyay, who is the market expert who joins in now. Sudeep, BMC elections, do you think there would be any sort of rub-off on Mumbai-based real estate players? That's something that everyone wants to speak about. And the other part would be any of these Mumbai-based infra companies, do you think there could be any fresh tenders awarded, etc.? Is there a play there?
Well, not too much, Mangalam. I think, effectively, the government had been running BMC for the last few years, and a lot of activity as far as tendering has already happened. I'm sure the momentum will continue, and that's good news as far as these companies are concerned, both real estate as well as the infra companies. I think the development pace will be maintained, probably even get accelerated. So I think it's good news for these companies, but I'm not seeing anything significantly incremental happening as far as these companies' fortunes are concerned.
Okay.
Nigel, what we're going to do is just take a quick look at the rupee, and we'll come back and get more opinion as far as individual stocks, etc. are concerned. I think Lata is with us. Okay, she should be with us in just a bit. It's a big one. I think there's some recovery in the rupee, right? 90.84, 90.76 now. So
it's interesting is that Ritu this morning had told us that when the rupee moved from 90 all the way up to 90.34, 90.44, she said between that period, there was no any help coming in or support coming in from the RBI as well. And from there as well, the rupees only worsened. And, closing in on that 90.8, just that big positive take that happened from 90.84 to around 90.76. We don't know whether it's some big bank support which is coming or not, because, that would have meant a much stronger pullback. But that's not happened. The intervention hasn't happened yet.
And Lata's been working the phones and speaking with dealers, etc. And she'll be able to tell us if, this is the RBI supplying some dollars. We'll go to her in a bit. Well, Reliance will report numbers later today. And let's get a quick snapshot view in terms of what the expectations are looking like here. Sonal is joining us now. Sonal, over to you.
Well, it's expected to be a strong quarter this time around, but let's talk about the stock move first. The stock, remember, is down around 6% in last 1 month, but in the month of January, it did hit its record high level, came in at around 1,611 rupees a share on 5th of Jan, and the stock trades at 27.2 times FY27 EPS. In terms of the consolidated expectation, revenue is expected to fall by 3% on a quarter-on-quarter basis, but the EBITDA growth will be decent, 5% on a quarter-on-quarter basis, leading to a margin expansion, which is expected to come in at 19.45%. Profits accordingly will see a growth of 6.6% to come in at 19,365 crore rupees. Now let's talk about the segments. It's the oil to chemicals business this time which will drive growth for the entire company, and this is because of strong GRMs. Singapore GRMs, they are up 97% on a sequential basis. However, weakness in oil and gas segment is expected to continue because of lower volumes and pricing as well. The festive season demand, that is something which will aid growth for the retail segment. And if we talk about the Geo business, that is expected to see a growth of 16% on a YOY basis, 2% sequentially because of higher ARPU and also subscriber growth. Overall, we'll be watching out for some announcements. Clarity on the new energy business, expected to see more capacity coming by on stream, growth in retail store additions, and any pricing action in the telecom business. These are some aspects that we'll be watching out for in the management commentary.
Okay, all right. That's Reliance for you. Polycab numbers are coming at the bottom of the screen. 7636 is the revenue. It's, about 1,000 odd crores higher than what the CNBC-TV18 poll suggested. And I think EBITDA, though, is largely in line. 970 crores compared to about 980 crores, which was the expectation. 620 crores is the net profit. And this compares to 644, which was the poll. I think we'll have Upasana join us in just a bit with more details on this one, margins, etc. As we
sense is that the margins will be lower than the polls, largely because the revenue is higher and the EBITDA is largely in line. And the factor that could play out is input prices. We've been talking about how copper prices have seen a big surge, etc. So maybe a large part of the revenue growth would be value-led as against volume-led. And we'll get more clarity on those numbers, which is what explains why the stocks also lower post its numbers. Not that it's gone great guns either in the recent past, but it's lower post numbers despite a revenue beat, because that may largely be a value beat, not a volume beat. And the EBITDA in line with expectations implies that there is margin compression. And at the same time, okay, there you have it. Margins at 12.7% versus a street expectation of 14.5%. And there is disappointment on the net profit as well. 620 crores as against street expectations of 644 crores. But
these cable and wire companies, Mangalam, I think as we've spoken with many of them, right? The copper price thing, it'll show up in the revenue. Yeah. But will it hurt I don't think that is the reason for the margin because it's passed through. It's completely passed through, straight up.
That impacts volumes.
Volumes is the problem. But here, we'll have the, I don't know, the value and the volume number. We'll ask the management when they join us. But it's interesting. The margins are also under pressure. And I wonder why that is the case. But maybe Polycab, of course, is not just cable and wire. They've got the...
No, the FMEG business is in the green. That's in the green. I had a look at that itself, and it's improved, actually, the FMEG business. So the miss has not come because of that. But there's another smaller part of their business, which is the EPC business. So it's a small part of their business. There is some margin pressure out there. And obviously on the core business as well, the big top-line growth, the profitability has not kept up out there. So FMEG continues to remain in the green. I think the last time the management had told us that as well. Broke even in the September quarter. They said it will stay in the green. That's what's happened out here. On a year-on-year basis, FMEG delivers a profit versus the loss. But I think the other verticals, there is some kind of margin pressure out there. So the top-line growth is good, but the margin compression is something that the street will be a little bit disappointed on. We'll have to get the trajectory going ahead.
Absolutely. We'll have our a research team also join us in a bit with more. The rupee's fall and then slight recovery, right? What's at play? Lata is joining us with some intel. Lata, over to you.
A rather bad day for the rupee. It's fallen by about 0.6%. Which is unusual. I mean, over 0.5% fall is certainly not usual. And what's unusual is that other currencies have not fallen. It's basically, once again, the worst performing currency. The immediate trigger could be the December trade data. Not that it was as bad as the September or the October data, but it's still showing the pressure. You know, November trade deficit was $24.5 billion, goods trade deficit. The December trade deficit is 25 billion, over $500 million. And particularly exports to the US have fallen by 7% in December compared to November, which means the pressure is beginning to tell. You know, who is to say that things don't get worse? Electronics and services exports, normally good numbers, they're good, but they're not outstanding, not enough to beat the blues. Then that is the current account, but look at the capital account. We've been continuing to see capital outflows by FPIs, and the market suspects that today is going to be yet another 500 billion, 500 million kind of sale. Every day is about $500 million in the past few days. And today, to counter it, the usual RBI dollar supplies have been lacking. Is the general market chatter? We don't know. Anecdotally, that's what dealers tell us. So just for the record, the all-time low is 91.07 rupees per dollar, hit on December 17th, and the all-time closing low was hit the day before, December 16th, at 91.03. Still a distance away from that, but looks very much like in sight.
Looks like that, Lata. You know, just moments ago when we were looking at the rupee, it had come a little off the lows of trade at around 90.72 thereabouts, but that decline has, or rather that appreciation has been sold into back around that 90.8 to the dollar for the frontline index. Meanwhile, the cut on Polycab deepens a little more. It's down about 3.5%. When the numbers hit the screen, it was about 1.5% lower. We'll take a short break. In fact, there you have it. It's a vertical decline that we've seen on Polycab. Take a short break, come back, more market talk lined up on the other side. All right. We do have the Nifty just holding around that 25,700 mark, and mid-cap's actually given up all its gains. The story of the day can be looked at in the advanced decline, right? For most part of today's trading session, we had more number of stocks advancing than declining. Sometime in the middle, those lines did intersect, and now as we speak, around 1,700 stocks in the red for about 1,200 in the green. But big numbers coming in over the weekend. Gaurav joins in. He has ICICI Bank. What's the street expecting this time around? Gaurav.
Yes, if you look at ICICI Bank, street is expecting around 11% growth in terms of loans and around 8.5% growth in terms of deposits. Now, I'll tell you the numbers, why they expect this. 3.5% on a sequential basis is something that the street is expecting, but we may see a positive surprise here. And the reason being that if you look at a system level growth, it has already been at around 5% in this quarter itself. And that is the reason why, given that ICICI Bank has a tendency to outperform the market, we may see some outperformance here as well. Apart from that, net interest income, PPOP, we may see a stable growth here. Profit is likely to increase just by 5% on a year-on-year basis, and the reason being that this quarter is specifically higher, expected to be higher in terms of slippages because of the agri loans that they provide, because Q1 and Q3 is usually seasonally higher, and that is the reason why credit cost is likely to increase. But at the same time, street is also expecting net interest margins to expand almost by 3 to 4 basis points, and the reason being that first is CRR rate cuts, and second is the deposit mobilization and the deposit repricing that is happening throughout the industry. Other than that, a key thing to watch out for is the commentary on the clarity of MD and CEO, Mr. Sandeep Bakhshi, because remember, his term ends in October 2026, and any clarity on that is a key thing to watch out for. And other than that, commentary on growth and margin is also something that street will be watching out for. But all in all, in terms of number, stable set of numbers with no negative surprise is what we're expecting from ICICI Bank this time.
Gaurav, thanks very much for that. That's ICICI. What about HDFC, Gaurav?
Well, for HDFC, we have already seen advances and deposits growth, but we also witnessed that the market was not happy with the LDR ratio, which crossed that 99% mark, because management wanted to bring that LDR ratio below 90%. So now, when it comes to numbers, they're expecting around 7% growth in terms of net interest income and profit. When it comes to PPOP, which is pre-provisional operating profit, we may see this number going as high as 9%, and the reason being that we may see some support coming up from the other income segment. Apart from that, net interest margins, here also the street is expecting 6 basis point of increase, and again, the same reasons, CRR cut and the deposit repricing that is happening across the industry. And credit cost, we are likely to see a stable credit cost in HDFC Bank, but once again, agri slippages and any commentary in terms of agri loans is something that we will be watching out for. Again, in HDFC Bank as well, beyond numbers, the commentary is going to be a key thing to watch out for, and the reason being that, as I mentioned earlier, LDR ratio, which has crossed 99% mark, how management sees this LDR ratio coming down, because street is very concerned about the growth going ahead. And apart from that, the loan book outlook and the net interest margins outlook is something that we will be watching out for from comments. But all in all, in terms of numbers, once again, a good set of numbers is what we're expecting from HDFC Bank in this quarter.
All right, Gaurav, thank you very much for that. That's ICICI and HDFC Bank, both in focus. By the way, the rupee is collapsed again. 90.76 or so when we were talking to Lata. It's back at about 90.86, I think the last I saw. 86.50. Yeah, there you go.
No intervention.
Sharp recovery, and then it's basically turned around just like that. 35 points is what you have as far as the Nifty is concerned. Sudeep, we just had the Polycab numbers, and we were talking about the Hitachis and the GE Vernova and the CG Powers of the world. One factor that just struck me is, of course, copper. Copper is critical to all these companies, right? There's all this China talk and this budget and what will happen, but you think there's a bit of a worry that margins perhaps will be under pressure across? I mean, actually, it'll be interesting to get a list of companies where copper is a significant part of the raw material list. These three, I'm assuming, transformers, any company, I guess copper will be. Your thoughts?
Well, Prashant, you're absolutely right. I think the way the copper prices have been going up will definitely put pressure on a whole lot of sectors. Some of these you just named. I'm also worried about the overall, the metal scenario, because while we are enjoying the bull run in the metals and metal-related stocks are doing very well, and if you have investments there, you are kind of making money. But the fact remains that even look at tin. I think after a long time, there is a rally in tin, and that again is a critical component in many industries. And we normally don't track these metals so much. So definitely we have to be very, very careful. While all the analysis we didn't factor in that earlier, But now I think time is coming where we have to factor in, this kind of shocking rise in metal prices and a whole lot of them. Look at what's happening to aluminium, and I think it's expected to remain where it is. Of course, we have seen it getting played out in silver. I'm not talking about precious metals. I'm talking about silver, which has a use in industry as well. So industrial use of metals, while it has been increasing, the metal prices have been sharply moving up, and it's definitely a matter of worry. I'll be definitely worried about the consumer durable industry, which uses quite a lot of them. And we were expecting good times for consumer durables. So I think this is one worry. EV also needs to be careful about, because a lot of these are used for EVs.
Right, take that point, Sudeep. Thanks a lot for that. As we speak, lemon tree, let's move to the low point of trade. There was a note this morning that came in which suggested that maybe, this demerger exercise does not unlock a lot of value, largely because the resultant players, one of them will have holding company discount for Fleur. So as a result of which that stock's lower. We are seeing some declines from the highs on even bazaar-style retail. When we spoke about it, it was up 18-19%, now holding with gains of just about 7%. Landmark is the other one, which is down 8%. But all in all, let's start wrapping. It was one of those days where the markets started off fairly well. At midpoint was closer to that 25,900 mark.